Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody. I'm really excited about the conversation today with Patrick Pinschmidt, who's the general partner and co-founder at MiddleGame Ventures, and who's got a fantastic career across Wall Street, across financial services more broadly, touching regulation technology, and now investing in the space. Patrick, welcome to the podcast.
Thank you, Lex. It's great to be here with you, and looking forward to this conversation.
Absolutely. So before we started, we actually figured out that we have somebody in common that we worked with in the equity research days. Maybe we can use that to start off, a conversation about your journey across the public and the private markets and where you started your career and kind of how you got focused on financial services.
Yeah. Well, we should give a shout out right off the bat to Guy Muskowski, who I worked with for 8 years, and I know you worked with in your prior life. But I was sort of an accidental participant in financial services coming out of school. I was a history major, liberal arts, and my first job coming out was in financial services, and I've been hooked ever since. And my path has been a little non-traditional as to where I am right now. I spent a decade as a sell-side research analyst at Morgan Stanley, Merrill Lynch. I had the good fortune of being able to cover financial services while working in financial services as a sell-side analyst. And as that really gives you a very interesting vantage point. You can kind of talk to people internally. You can talk to people at other firms. You're talking to, different investors and market participants. You're basically, learning everything there is to learn and coming up with a view on macro trends as well as individual company trends. And it's just an amazing opportunity to really learn an industry inside out. It can be quite grueling, as people know, but I did it for 10 years in a period that, encompassed, that first wave of financial technology. It wasn't even called fintech back then. It was called financial technology. And, I was covering exchanges, so NASDAQ, New York Stock Exchange, when they both went public, as well as some of the broker-dealer firms and market structure entities. And absolute fascinating time, kind of the building blocks of the capital market system, and just a huge amount going on. But all good things. After 10 years, I was really trying to do something else. And I had always sort of grown up with a public policy bent. And, when the new administration came in the wake of the financial crisis, I had the opportunity to go to the Treasury Department, where I helped.
Let me pause you there, because that's a switch to a fascinating topic as well that I want to dive into. But before we go there, I've got two questions around the Wall Street equity research work. And the first is just a definitional question, and the second is about what the future looked like then. So the definitional question is, you mentioned sell side versus buy side. Not everybody knows what that means. If you could just pause to open up for public markets what that means.
Yes. Sorry for kind of jumping in with lingo right off the bat here. So the way to think about sell side versus buy side is, I guess it's easier to start with the buy side. The buy side is the investor side of the house, the asset management side, who are buying shares in companies and taking ownership stakes to hold for institutional portfolios. So the BlackRocks, the Fidelities of the world. The sell side, on the other hand, is the broker-dealer side, which provides the services to the buy side to execute those trades, to identify good opportunities. And as part of that, there are fairly significant research departments across the major broker-dealers that publish research on different sectors as a service to their institutional investors.
How do you see that having changed over the time that you were doing that role, as well as, till now? How has that relationship between the sell side and the buy side evolved? I can imagine in the earlier 2000s, and especially through the first internet growth market, internet bubble, that relationship was really different than what it is now.
Absolutely. I think I was fortunate to avoid some of the internet bubble period in my career in the sell side. And I think during that period, it was very much sell side research was looked at directly as a revenue producing side of the house, where it worked very closely with the investment banking businesses. And, it did create the appearance and certain challenges around the business model for sell side, because analysts were perceived as being more valuable based on how many IPOs were in your space, as opposed to what your views on the space were and kind of the value add and the analysis you were doing. And fortunately, there was a period of reform coming out of the internet bust. And that kind of coincided with my time in the space, where you were incentivized based on the quality of your work, the thoughtfulness of your analysis, the ability to kind of look across a sector and understand what are the trends, what are either the competitive issues that are going to impact the coverage space, as well as different areas of opportunity within financial services. And at this time, talking, the early 2000s here, you had NASDAQ going public. It's the first exchange in the equity space shortly after CME in 2002. And then you had the New York Stock Exchange following on. And then you had a whole host of electronification, financial technology, the entities going online and disrupting that traditionally stayed capital markets space. So, and from my perspective, it was an excellent opportunity to leverage a lot of internal resources, whether it's the trading desk at Merrill Lynch or Morgan Stanley, whether it's the market structure folks at both of those firms, and kind of understanding how they were seeing technology impacting their business and what were the different alternatives to trade on, and kind of what were the implications for the business model today, as well as potential new entrants in the space. So it was very much a great way to just kind of get inside of an industry, talk to people internally, talk to people externally, and interact with a lot of very smart people on the buy side. And I think that sort of relationship and the balance and the role of the sell side has moved in a good direction, I think, over the last 20 years, in the sense that there's a lot more focus on working on the analysis and trying to be differentiated, and not just coming out with the cookie cutter tomes that kind of recite earnings reports, but trying to really distill what really matters, because there's a lot of noise in the marketplace. Clearly, I think the tools available to analysts have improved significantly. I mean, again, I've been out of the sell side for almost 10 years now, so I'm not as close to it. But back in the day, you kind of read the 10Qs and the 10Ks, and you talked to a lot of people, and you didn't really have a lot of automated assistance. Today, there's a big push on alternative data and kind of leveraging that data to come up with different ideas as to, what's driving the industry. I mean, I think the closest I got to alternative data in my time on the sell side was probably in 2003, 2002, kind of coming out of that market break following the dot-com boom. And, everyone was wondering, well, when will business get back to normal? And there wasn't a lot of activity. And so we kind of came up with this metric, which clearly not the most technologically savvy, but quite effective, where we would reach out to all the different black car services at the different investment banks on a sort of a biweekly basis to understand which shop was busier than the other shop, where the line's longer at Merrill versus Goldman Sachs or Lehman Brothers, and use that as kind of a proxy. There's a lot of kind of more tongue-in-cheek than anything else as to where activity was picking up, or which investment bank was working its analysts harder, and was that a sign of a recovery in the market, because everyone was wondering when things would start to normalize.
That's amazing. I wonder if there's, like how many people are waiting in what halal food cart.
Yeah.
would have also been a good New York data point. I echo your point about access 100%. I spent about 3 years with Autonomous setting up the fintech practice, and it's so refreshing to have that power dynamic flipped. So when you're an entrepreneur and you have some vaporware software that you're trying to sell into a financial institution or a bank, or try to make it feel important, the power relationship is very challenging. You're always on the outside of these companies. But from the equity research role, you are the outsourced brain for institutional money managers who rely on you to do a lot of their thinking in some cases, who are then the entities that own all of these banks. And so the CEOs and the boards and the strategy teams and the senior leaders all essentially report to their investors, who are relying on analysts and researchers to create a thesis. And essentially everything's open, from every innovation team to strategy team. And that was just a really interesting experience to be able to have that access and to understand all the vectors of change and all the ideas that are floating around the industry.
Yeah, absolutely. That was a much more concise explanation than I just gave.
So putting yourself back into the 2000s and like post-internet boom, and with financial technology just starting at the infrastructure and middleware layer to gain its popularity in the public eye, right? And before Mid.com, before Silicon Valley got to fintech, what did the future look like to you? What were the stories that people were telling about how financial services would look like over the next couple of decades? Because I'm sure, there were prognostications, and then there were framings and entrepreneurs telling stories. Anything stick out to you in terms of what people thought would happen and where we are today?
Yeah, that's a very good question. I think all the energy at that time was in the electronification of the equity markets and to some extent the future markets. I think CME going public in 2002, that was a huge event. They had Globex, which was an electronic trading platform, and they basically were gobbling up market share in the commodity space, and kind of seeing what was going on in futures. And then you had INET, you had Archipelago, you had a lot of these electronic trading platforms that were just coming online and gobbling up market share also. So a lot of the focus was on the transition from sort of floor trading, manual trading, to electronic trading with lower costs, less friction. And a lot of the debate, particularly from the industry perspective, and whether you're looking at this from a broker-dealer perspective or an exchange perspective, would reduced friction and increased ease of trading, which would naturally produce an increase in volume, but also lower average pricing, would that offset the higher volumes and the greater activity, offset the lower pricings? And what would it mean for market shares and kind of the revenue model of some of these firms? And clearly, two different challenges. If you're a sell-side brokerage house relying on your balance sheet, that became less of a required entity, particularly in the equity space. And if you're an exchange with a floor trading platform, that obviously wasn't making a lot of sense. So it was kind of that evolution of trading from manual to electronic and the impact across the industry. There frankly wasn't a lot of other aspects of the capital markets ecosystem. Obviously ETFs were coming online at this stage, so there was an increased amount of indexing, but it wasn't as pronounced in terms of the technology changes as you saw in the trading. And I think the big debate back then was, well, how quickly can you take what's happening in the equities market and make it happen in the fixed income market? And that continues to be a question mark. Obviously very different markets, very different liquidity mindsets, and it's a lot harder to electronify markets that don't have a robust sort of inventory of willing buyers and sellers. So obviously it's been a longer kind of arc for more traditional fixed income markets, aside from obviously the very super liquid short end of the treasury market.
Yep. It's interesting to hear the words, right? Electronification, and then it becomes automation and digitization, and then it becomes tokenization. And it's every platform shift is telling the story of being more efficient and cheaper, and the Robinhood story about more volume at a lower cost and so on. So, okay, fantastic. And out of this, you transitioned to the US Treasury, right? Tell us how you got there and what happened.
Yeah, well, so I'd gone to school in Washington, and I kind of, always had a little bit of a public policy bug in me. And I'd been waiting kind of for the right time to find a way to get down to DC. And as I explained to my wife at the time, it would only be for 6 months or a year. I'll commute back and forth to New York and kind of be in DC during the week. So I basically, through just a lot of pounding the pavements and, talking to people, I knew I was able to find a role in the Obama administration helping stand up the Financial Stability Oversight Council at the U.S. Treasury Department. And essentially what the Financial Stability Oversight Council, or FSOC for short, I don't want to get into too many acronyms here, but was designed to do was, coming out of the crisis, there was a recognition that clearly the US market has this balkanization of different regulatory structures, different asset classes, different types of entities, and different types of institutions can all trade in the same market but be regulated by different regulators. And so therefore it was very difficult to kind of look across the system and understand where the blind spots were and where potential risks were bubbling up. And there were proposals like, well, maybe the Fed should be the systemic regulator of choice, or some of the regulators should be merged, whether it's the CFTC, the SEC, or the 4 or 5 different federal banking regulators. But none of that gained favor with Congress. And so the decision was made to create this entity that would bring all the financial regulators together with a collective responsibility to understand risks, share data, and have the ability to identify companies and products outside the traditional regulatory perimeter and assign them for heightened regulatory supervision or prudential standards. And so it was a absolutely fascinating time, and you're kind of creating something from scratch. There's no obvious playbook. There was the legislation and the law, and you're bringing a lot of people together from different agencies who have different priorities. But I just absolutely found it fascinating. I was using a very different side of my brain that I used as a sell side analyst. It was a lot of talking and explaining and gathering opinions and finding sort of a consensus to move forward on very difficult issues. But I eventually kind of got sucked in and staying much longer than I thought I would. And I ended up almost at Treasury for 5 years, and which was probably 4 years longer than I told my wife I'd do it. But again, it was just so much going on. The intensity of kind of the activity and the consequences of some of the decisions that were made. It was just very exhilarating from a personal standpoint, and being able to kind of give back and have sort of a very clear compass as to what your goals were was very gratifying for me.
It's fascinating, the idea to rationalize or simplify or cohere the regulatory system in the US, because from an entrepreneurial perspective, it is massively, massively challenging. And there's a number of essentially workarounds that have been built by technology and fintech companies, which are now flowing around maybe the desired order or the assumed order, and allowing financial services to be embedded at the edges of commerce and at the edges of user experience. And the question I would have when you were in these conversations and driving policy was, how was the global geopolitical regulatory sort of map incorporated into the thinking? Or like, was it incorporated into the thinking? And the question comes from a place of just seeing fintech innovation happen in a very global manner, with distributed teams, distributed funding, with European neobanks entering the US, funded by Tencent or SoftBank, with American brokers entering, the UK and Brazil, with American big tech companies like Facebook trying to do payments in South America and Indonesia, and vice versa, with Ant Financial spreading through to Europe and to Africa. And so, at least from kind of a very macro perspective, it feels like the way that you have regulatory arbitrage between the several states in the US, for whether it's incorporation or for bank charters versus federal versus local or REAs, what have you, there's this global patchwork too of people doing jurisdiction shopping and figuring out where to set up shop. And so it's a very long-winded wind up, but I think a lot about this global question of regulation, and I'm curious as to whether that's a reality, that's known, that's seen, that's part of the decision framework, and then if you have any thoughts on how the US could pierce towards being competitive there.
Yeah, no, a very, very good question. And so I think going back to my time at Treasury, and obviously the discussions and the focus areas have evolved since then. I think there was a recognition, rightly, that innovation was absolutely critical. And on the other hand, there was also a recognition that there's a lot incumbents, fintechs, and regulators don't necessarily understand about innovation in terms of the consequences. And the compass, if you will, at that time was not doing anything that would hamper innovation, but also not letting innovation get too far over the skis where it would present a risk, whether it's to the financial stability, market functioning, or the end consumer in terms of creating vulnerabilities. And certainly when you're dealing with regulators, I say this as it's not a criticism, it's more a feature than a bug, but regulators are going to move slowly, and they're going to want to see evidence, they're going to want to understand consequences. And it's not like you look at a pitch deck and say, oh, there's nothing there, and kind of move on. So that sort of timeline doesn't always sync up with fintechs in terms of the whole mantra of move fast and break things. So I think we're still today at that point where there's this struggle where regulators really, for good reason, have an obligation to protect the core, whether that's the financial system or the end customer, but also recognize that the financial system and the end customer can benefit from innovation, but making sure that it strikes that right balance.
So under the FCA regime in the UK, there's an explicit mandate for encouraging market competition and innovation. Where does that sit in the US? Is there any entity that has more of a mandate to encourage competition, new entrants, and sort of a better customer experience?
It doesn't really reside in any one particular place in the US. I mean, that's when you can compare and contrast the US regulatory system with other regulatory systems. They're much more centralized decision making, whether it's in the UK or other jurisdictions than we have in the US. And I think that has made it harder for the US to be a leader on some of these fronts. And while you have these sort of fintech labs within the different agencies, and you have sort of these efforts kind of on a sort of a cross agency basis to encourage more innovation, it's hard to kind of centralize that authority and kind of really drive that forward. I think obviously the Fed in DC, as well as Treasury Department, they play an important role there. The banking regulators, whether it's the OCC, the FDIC, they play an important role there. And then you have the different states who kind of have a different spin on things also. They're able to kind of play a role also. So it is still very much a hodgepodge. And I suspect that the new administration will be making more of an effort to try and centralize and coordinate to the extent that is possible across products that span different markets and different types of financial services providers. Because I think one of the main lessons from the financial crisis was the whole aspect of regulatory arbitrage, to the extent of looking for different jurisdictions to offer a product. If, for example, the OCC won't let you do it, maybe state XYZ will let you do it. Or if the CFTC won't let you do it, maybe the SEC will let you do it. And creating some level playing field for like products or like institutions operating in similar markets is obviously a worthwhile goal. But again, at the same time, finding that space to encourage innovation, because I think that's the one thing I think that often gets missed, is particularly in trading. And we talked a lot about sort of the evolution of trading markets, particularly in equities and how they've electronified. But if you look at the back end of some of these trading markets, post trading and clearing, that is still terribly backwards. And there's a huge opportunity there with technology. And this is an opportunity that solves pain points for regulators as well as market participants. For market participants, it perhaps reduces the amount of capital required for a trade. It increases transparency on your counterparties, and it fosters a healthier marketplace. And all of those things are great from a regulatory perspective, because capital can be deployed more efficiency. There's more transparency. You don't get the sense that markets will freeze because you don't understand who your counterparty is. So, I think there are a lot of areas of common interest, but these things do take some time, and they're a little bit thorny to untangle. And then in the meantime, what you see is happening where you're getting a lot of innovation around the edges, which is starting to seep through and really starting to reach critical mass over where we began 10 years ago, where it was sort of the front end. Now we're going into the middleware, and now we're going into the core, or the true back end of some of these financial services systems.
Absolutely. So with that introduction about how easy it is to start a fintech, I think we'll transition to your founding of MiddleGame Ventures, which is a fintech venture fund looking at early stage investments. Can you talk a little bit about what drove you to take that leap and that risk, and maybe your thoughts on venture style investments versus the larger public companies that you've covered, and the regulatory activities for mature companies, what your observations have been on that journey?
So when I was coming out of the administration in 2016, two things were very clear to me. I did not want to go back to sell side research, and all the energy was in fintech in terms of new products, new services, entrepreneurship. And I was very, very determined to kind of find a way to position myself to be involved in that ecosystem. And I was very lucky in my timing. I latched on with my two partners, Pascal Bouvier and Michael Meyer, who had just started the process of launching MiddleGame, and they had a fairly substantial track record coming out of a family office, a single LP that was one of the earlier forerunners into fintech investing, and they were looking to kind of strike out on their own. And they came at this with a venture track record as well as kind of that hands-on operational experience as entrepreneurs and former CEOs in financial services, two skills that I did not have, but they also recognized my background as looking at the incumbent industry space as a sell-side analyst, as well as on the regulatory side, complemented what they brought to the table and would hopefully enhance the ability of the team to kind of work with startups and be successful. And plus, when you're raising a new fund, it's always easy to add a new partner because there's no money just yet. So fast forward several years and we launched the fund with our first close in 2019. We are fintech only. We have a focus on Europe and early stage. We post seed through Series B. And again, I think, for better or worse, we are very hands-on. We like to take board seats, be involved in the founder's journey because it can be a very lonely and challenging journey. And it's always good to have resources around the table. And we feel collectively, given our different experiences, as well as kind of the network we have in the US, as well as the network in Europe, that can, of course, be advantageous for an early stage entrepreneur kind of starting out and looking to scale their business.
Can you talk a little bit about the thesis of the fund and maybe some examples of investments that you've made recently along that thesis?
Yeah, no, absolutely. So I think as we talked about my sell side days, there was a saying in electronic markets, liquidity begets liquidity. So the easier it is to trade, the more people will trade. And the way you get more people to trade and engage is to take friction out and lower costs. And I think that's a very, very relevant vantage point to where we are today in the fintech cycle. And, I think we fundamentally see over the next decade just a re-architecting of financial services with a focus on the back end. And essentially, what does that mean? It means digitization will beget more innovation as the core infrastructure digitizes. That will expand access. It'll lower costs. It'll reduce friction. And by rewiring the middle and the back end, it'll enable new breakthroughs, whether it's new products, new services, or new linkages across different platforms. And, I think this is going to be hugely powerful and compelling. And I think we're really only at that tip of that. We've seen a lot over the last 5 to 10 years in terms of, I guess what you could call kind of fintech version one, the attacking the front end, kind of the low hanging fruit around simplifying the customer experience, whether that's in payments with PayPal or retail trading with Robinhood. And now we're kind of going into that second and third phase, which is, coming after the middleware, leveraging cloud computing and APIs, whether it's banking as a service, whether it's Stripe, and then finally going after that core, which is kind of the direct embedded or frictionless finance, which will really kind of define how financial services are provided and by whom, and opening up a whole new range of products. In terms, I guess you asked, how does this translate into the portfolio and how we think about things? I guess broadly speaking, you could kind of look at this in sort of two different buckets. I think we've been very active investors in capital markets and asset management, as well as kind of, the open financial services category, which is, open banking plus, for lack of a better term. But when you think about some of the trends that we see that are kind of pivoting off of really reopening the core of how these markets work, and I'll start with capital markets and asset management. Obviously, we talked about this before, that the pre and post trade processes, kind of the merging of the crypto and the fiat universes from kind of a centralized to a decentralized infrastructure, obviously add-on benefits with tokenization and fractionalization, which will create new markets to issue trade and custody products. With all these new markets and new products, there'll be new ways of analyzing data and collaborating on that data and making better decisions. And that goes also to regulatory issues. RegTech, obviously everyone talks about RegTech. There hasn't really reached its promise, but as this new world digitizes, there'll be RegTech solutions that will have to evolve to meet that demand, in addition to kind of correcting for catching up on some of the current RegTech requirements. And then, finally, I know it's a very popular topic, and there's more talk than innovation at this stage, but there's a lot of energy around it in terms of ESG. And I think that's going to become huge in the capital market space. And I think when you think about new applications there, the G is going to be very interesting in terms of the governance and how that works, and creating transparent, simple, and automated governance frameworks that could potentially redefine the sell side and buy side relationship in terms of asset and trading of assets. In terms of our portfolio, we've done, I guess, 9 or 10 investments, and I guess half of them would fall into the capital markets and asset management backdrop. Like Navora is one of them. It's a trade platform that's leveraging DLT, that's automating the pre-trade process, as well as creating economic ways to issue lower denominated debt, lower levels of debt, because the economics for 25 million debt offering just do not work, and trying to find ways to automate that process and do it much more effectively and in a technology first manner is immense. So that's definitely a company to watch. They're very much pioneering some great solutions, but these are long sales cycles, and these businesses do not evolve overnight, just given the different stakeholders. But we've also invested in a company called QRock, which is in the crypto space in terms of market making and trading applications. We've invested in a company called Netscape Technologies, which is automating the net asset value calculation for the asset management space. Huge pain point, a lot of Excel worksheets today, and kind of bringing that to the 21st century is a very noble undertaking. And they're very early in that journey, but making a lot of progress. And then another company called CapDesk, which is for the private markets, but essentially it's kind of like what Carta does, but for the European market, and providing cap table management systems for private companies. And ultimately, once you kind of manage your cap table and you have kind of a centralized database within companies and across companies, it opens up opportunities to create new markets. And so that's a very interesting one also. And then kind of separately, if we think about the balance of the portfolio, there is a huge emphasis now, obviously, in open banking. And I think open banking is a very limited term, because it doesn't really get into the other adjacencies, whether it's not just about banking and payments, but it's expanding the whole financial services rails to non-financial entities via embedded financial functions, and integrating this through APIs. And the core trends that we've seen and that will accelerate over the next few years, it's obviously kind of the network interoperability and the stitching of the functionality. Obviously, Plaid is an example of that. Broader customer engagement tools where you're opening up new markets for SME lending, for example, and other customer segments that might not otherwise be economical for traditional financial services firms. But when you can get the sort of capture the data in terms of payments coming in, payments going out, and understanding the inventory flows, you can make very smart credit decisions. And then obviously, I think in order for these new ecosystems to really mature and work, it's important that there's a very robust backbone of identity, privacy, and security, just to make sure people trust it, as well as make sure it can run efficiently and effectively. But we have a handful of names in this portfolio. Railsbank is one of them. It's a banking as a service platform that really is going very hard and leaning into providing kind of the payment rails for non-traditional financial services firms. Mina Technologies is doing a great job with a subscription management service that's sold directly into incumbent banks, providing a way for banks to engage more with their end customers, as well as allowing them to more efficiently manage their payments and subscriptions. And Wayflyer is another example that touches upon my point previously on providing embedded lending to e-commerce based on superior data in terms of what's going on with the inflows and outflows of the companies. And then finally, our most recent investment in Payslip fits into this kind of open financial services ecosystem. It's a payroll management firm that's stitching together different payroll applications for multinational companies and creating a common framework and a common currency for that data across different countries to talk to one another. And once you do that, you get better data internally, but also you can make better decisions and you can actually layer in additional products on top.
Fantastic. Thank you for articulating that. And one way that I often simplify the dynamics of the market is into the factory, the storefront, and the value chain in between. The storefront is the distribution, and fintech has been focused largely on that. And the manufacturing is what you've called the core, and blockchain-based infrastructure is rewriting how we manufacture financial products. And so I want to close out kind of with asking again a question around a company like Payslip, which is focusing on that middle part of the value chain, right? Not manufacturing necessarily the payments and not necessarily being in front of every consumer to sell them a bank account, but really being the connector and the glue between different endpoints and doing so in a cross-border way and kind of figuring out all sorts of complicated business processes to automate. How do you think about what makes companies valuable that are focused on that middle part of the value chain, the connectors, the people building the glue between the factories and the stores? What makes them valuable, and how would you project that part of the fintech industry for the next couple of years?
Yeah, no, that's a very good question. It sort of goes to the heart of the matter here, I think. And so I think when you straddle both of those worlds, it's important that number one, you're solving a near-term pain point. And then number two, by solving that pain point, you open up the potential for new products. And that's exactly what Payslip does. It helps multinational companies who don't want to go with a standardized payroll provider like ADP, want to have different payroll providers in different countries. And while that's great because they have very bespoke needs, it can lead to kind of disarray in terms of internal systems and kind of understanding what's going on in one country for the other. And the systems don't talk to each other. So Payslip comes in as it creates that middleware where it standardizes the data across different regions, across different payroll providers in different countries. And out of that standardized data, the employer gets a much clearer picture on what's going on with compensation, what's going on with payroll, what's going on with benefits, and kind of can sort of make the decisions that need to be made at the CFO level based on real time and correct information. And, obviously also save a lot of money and time in the process of doing it. But the sort of the next step there is once you do that hard work through that wedge of sort of the workflow automation that Payslip's doing, you create a kind of a standardized template with a lot more data and a standardized template that's much more amenable to bringing in new products and creating an ecosystem. And I think that's where a lot of the value when we look ahead in terms of what fintechs can do while partnering with incumbents and bringing in other fintechs into an ecosystem where new products can be brought to bear, where you're not necessarily disrupting, but you're working with the employer, you're working with the employee to bring products that are relevant based on the data that's created on the platform. And I think that's hugely, hugely valuable. And everyone talks about open banking being kind of ground zero, or the ability for retailers to offer financial services. I don't think there's anything closer than actually getting to the point of the paycheck and looking at that value tree in terms of whether it's investing, whether it's savings, whether it's lending, whether it's 401k, and providing all these add-on services in a way that could be very compelling. But again, before a company like Payslip or others get there, there's a lot of hard work that has to be done in fixing that pain point. And I think it's a very interesting use case in terms of creating a platform and creating a new channel that sort of sells itself on the way in. And then there's an ability to upsell as you've proven your worth and you've created a standardized mechanism to look at data and add new functionality.
Absolutely. So I think the way that Google organized its monetization around search and intent, I think the same is happening for financial products, which have been crowbarred out of bank branches and a push structured sales force and are now really living around financial events and intent from a customer perspective and are just going to be at the fingertips whenever you need them. Thank you so much for hopping on the podcast and sharing your absolutely fascinating story. If people want to find you or MiddleGame, what's the best way to do so?
Our website is middlegamevc.com or feel free to message me on LinkedIn.
Awesome, Patrick. Thank you so much for joining.
Okay, thank you, Lex, for having me. Really enjoyed talking.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.